Hello, and welcome to our October 2025 Market Outlook and Positioning video. My name is Derek Varner, and I'm joined by my friend and colleague Martin Wilde. Hello, Martin.
Hey, Derek, good to see you.
Likewise. So, in this video, we're going to walk through what's been happening in the market and the economy year to date, and then we're going to talk also about our outlook for the rest of the year. So, I'll start with just a quick performance update. We had a really nice performance in equity markets in the month of September. So the S&P 500 returned about 3.6%, and that was really led once again by technology companies and some of those companies that are artificial intelligence adjacent or enablers of the artificial intelligence build out. But in general, the market gains were broad-based across stocks and bonds. And then year to date, we've seen healthy returns in the S&P 500, up about 15% through September 30th. And this follows 2 years of very solid double-digit gains in 2024 and 2023. What's encouraging this year, as we've talked about in past videos, is that we're seeing broader participation across other asset types, whether it be small cap companies, which are up low double digits, or even foreign equities, which have benefited this year from a decline in the US dollar. So diversification across market cap and across geographies has benefited portfolios this year. But Martin, any thoughts that you'd like to interject about performance that you've seen this year?
Yeah, no, I think I'm just encouraged that we're seeing more participation, especially recently from some of the smaller companies and things like biotech that had been lagging behind. And yeah, I think it is a good reminder why we include international diversification in portfolios. If you look at last year in 2024, there was a significant lag versus domestic markets, and you see that reversing this year. So there is the benefit of those markets doing better in a weaker dollar environment, and that's what we're seeing this year. So yeah, that's encouraging to see.
So since we last recorded, we have seen some movement with the U.S. Federal Reserve. So the Fed held a meeting in September where they continued to lower interest rates. They had been on interest rate reducing cycle for a lot of 2024, but then paused in most of 2025 because of concerns around inflation and uncertain trade policy and the potential ramifications of that on prices and the economy. But in September, the Fed once again embarked on lowering interest rates in pursuit of getting back down to quote unquote a normal Fed funds rate of around 3%. The Fed is a little bit stuck in between a rock and a hard place right now because we are seeing inflation start to potentially reaccelerate a little bit as the economy has started to also reaccelerate and grow. But at the same time, the labor market and the employment market has been soft. So that's something we're watching that the Fed, they have this dual mandate of trying to promote price stability and full employment. However, prices are not yet showing signs of complete stability. We're still seeing some potential signs of inflation that may be partially caused by tariffs, partially caused by a lot of the spending from the build out of artificial intelligence data centers. However, again, as I said, the last few months we've seen some softening in the labor market, and this month the ADP jobs report actually just showed a decline of about 30,000 jobs. So that's front of mind for the Fed. And so, Martin, what do you think is their next step from here?
I think they telegraphed that they're going to likely continue to cut a little bit on the short end. I think you're right. They are in a difficult spot right now. We just showed some of the economic growth numbers being well over 3.5%. So if we're in a higher economic growth environment and inflation is starting to reemerge a little bit, it's really hard for the Fed to be on a sustained rate cutting cycle. But I do think they've already telegraphed getting rates down below where they still sit today. It will be interesting to see if it has a meaningful effect. You mentioned the labor market softening. We are seeing some of the new job additions numbers drop off pretty significantly as this graph shows. And I just wonder how much of that is interest rate sensitive versus some of the other things that we're seeing with broader AI trends and maybe companies being able to do more with less because of the productivity. So we'll see. But I think the Fed is rightfully nervous about the inflation risk and reaccelerating inflation to the upside. So they're in a tricky spot right now.
The other item that I think is unique, and as we're recording, the U.S. federal government has shut down. So the House is trying to reach an agreement on an appropriations bill for fiscal year 2026. The longest shutdown we've gone through actually occurred in 2018 and 2019 was roughly 35 days. Typically, they last anywhere from, a few days or weeks, and again, the longest more than a month. As these shutdowns march on, organizations have to make tougher choices about furloughing workers, or workers have to consider working without paychecks off. Historically they've always been repaid in arrears, but I think that creates some uncertainty for the economy. It's possible by the time we were recording this on October 3rd, the government shut down on September 30th. It's possible by the time that we distribute, things are resolved and reopen, but that is something that we're watching for and we're tracking. Martin, any thoughts on the government shutdown?
I think you've seen the markets shrug it off, and I think that's because in all prior shutdowns, there has been a resolution and people have gotten, back pay. It hasn't really been a big disruptive event at the end of the day. The thing to watch for is probably if this draws on, where markets I think would be more sensitive and more volatile would be if there was any risk of key payments being suspended or any threat to the treasury bond or other important debt obligations that we have. I think we're a long ways away from that because of how the treasury can prioritize, but the longer we go into a shutdown, the more the risk of something getting fumbled there increases, and I think that would make markets nervous. So if it's a relatively quick resolve, I think markets just look past it. If it drags on longer and longer, I think that's where we start to see other risks emerge.
And I think one of the risks that we're tracking just is valuation in general, in addition to some of the kind of geopolitical risks that we've talked about. So stocks, particularly U.S. large companies, are showing elevated valuations, and that's really driven by the enthusiasm around artificial intelligence. So here we show the forward price to earnings ratio for the S&P 500, and you can see trading, basically at the highest levels we've seen since the dot-com bubble. Now, this is not to say we're in the dot-com bubble, but we are noticing some corollaries, and it's causing us to consider some risk management steps in the portfolio. But when we look across lots of other asset classes, we see that the valuation extremes are really concentrated again in those large growth companies, which are trading at their highest price to sales ratios in the last 15 years. Across other asset classes, just like the equally weighted S&P 500, so all stocks equally weighted without the effect of technology companies, trading a little bit elevated. The blue line, or the blue dot, is current price to sales ratio. The yellow is the long-term average. And we look across dividend stocks, mid small cap stocks, foreign and emerging markets. We don't really see those same kind of valuation extremes. So these are great companies. They are in many cases very essential services. Apple making iPhones, NVIDIA making chips, building out the artificial intelligence kind of revolution. But we're seeing more and more, let's say, exuberance from the perspective of investors, and that's just causing us to be cautious. But Martin, what are your thoughts on where we see opportunities in the market today?
Yeah, the only thing I would add is I agree with everything on the lots of opportunity outside of the big, large technology stocks. But you'll notice the very first bar on the left is the S&P 500, and it's also at the very top end of the range. And one of the reasons for that is that the big technology complex has become such a large driver of the performance and the weight of that index. So if you think about the S&P 500, historically very diversified, the Fortune 500, big blue chip companies, we now see about a little bit over 40% of that index is in the top 10 holdings. So if I think about the valuation concentration, those are the stocks that are expensive. And I think that there is some risk to the broader market because they have become such a big part of something like the S&P 500. So I think it's more important than ever to have diversification into other asset classes that are not represented by the S&P 500 and the big tech complex. We still want to maintain some exposure there, but we just want to be careful of the level of concentration.
Yeah, that's well said. So let's wrap up with a quick summary on our view of the economy and market. So we do view the economy as moderately positive today. We're seeing, as you said, Martin, kind of above trend growth in the U.S. economy. We are seeing some softening in the employment market, so we moved that down this month to neutral. And then households we've had as neutral for a long time because households continue to spend, but increasingly reporting nervousness about their financial future and fatigue from inflation. So that's an area that we're watching, but cautiously optimistic on the economy. Financial conditions, we're seeing monetary policy and interest rates trending in the right direction. So I think we're close to moving this in this dial to a more positive position if we should see inflation confirm that it's not going to reaccelerate. And then lastly, on the market side, we list valuations as neutral predominantly because of that bifurcation we just talked about. The big S&P kind of household names look expensive to us, but we still see lots of other areas of opportunity. And earnings, corporate earnings, whether it's within the technology complex or outside of that, we are seeing earnings be generally solid or positive and above expectations. So our market view is moderately positive as well. But Martin, I invite you to share any thoughts or any parting thoughts for this month's video.
Yeah, the last thing I would say is there's an old saying that stock prices follow earnings, and we have had remarkably good earnings so far this year. So companies are doing well. They've found ways to navigate the interest rate environment, inflation, now tariffs, and I think they've done a remarkable job. We're actually just embarking on the release of third quarter earnings. So we'll see if companies are able to maintain that positive trend. But as long as we see continued fundamental strong performance on the level of companies and the earnings they're reporting, I think that provides a lot of support to the market. So that's something we'll be watching closely.
Well, that's great. Well, thank you everybody for watching this month's video. Please give us feedback if you'd like us to cover any topics. We appreciate your trust and we appreciate your attention today. Have a wonderful October.
Thanks, everybody.
Thank you.